Ladies and gentlemen, please welcome Senior Managing Director, Victoria, Matt Haddon.
Good morning, everyone. It's great to see so many people here this morning, the cream of the property industry in the room. To those of you who got on a plane to travel here, thank you. And to those of you who got up at an ungodly hour, thank you as well. You know, it's an important event in the property industry when Neil Bryson wears a tie. It's the first time I've seen it for a decade, so thank you, Neil, for doing that for us today. The context of this morning's presentation is a little different than you've seen before. It's impossible to understand what's going on locally in property at the moment, I think, unless we have a look at the global context. So the property doctor, Nick Axford, our head of research for Asia Pacific, has flown in from Hong Kong specifically to talk to us this morning about what's going on in a global context and how that's going to impact on our local market. Kevin Stanley, who's obviously known to all of you in the room, will then take a more micro look at what's going on in the Melbourne market, and that will be followed by a slightly different format. Our new, energetic, proactive leadership team will join us here on the stage in a panel discussion. Some faces will be familiar to you and some are new. So we look forward to introducing those team members to you later in the presentation. But without further ado, it's my pleasure now to hand over to Nick Axford to commence the presentation.
Good morning, everybody. Thanks, Matt. And it's the first time for many years that I've been back here in Melbourne, so it's a pleasure to be here. As Matt said, the focus today is very much on what's happening here in Victoria. But it probably hasn't escaped your attention that there's quite a lot else going on in the world at the moment, most of it not terribly helpful. So we thought we'd start with just a few minutes talking about what's going on in the world from a bigger political and economic perspective, and particularly trying to identify what does that mean for what's going on in the occupational and investment side of the property markets from a general perspective. So starting at the top, I mean, it's quite clear that the world changed last summer, or more importantly, probably, people realised that the world wasn't the way that they thought it had been. The light green line here shows what GDP was expected to do in the middle of last year, at the point where that dot was, and you can see that after an expected slowdown in the first half of 2011, the world economy was expected to then start showing a bit of a recovery, and in fact it did the opposite. It continued to slow, and the expectation at the start of this year remains that we're going to see continued slowing as we come through probably certainly the first half of the year, before hopefully we start seeing some sort of recovery coming through. Now, the thing you hear very often around here in Asia Pacific is, of course, we're different. We've got China, the drivers of the economy are more domestic now, that fantastic word decoupling. Well, to some extent it is true. There's a lot more dynamism, a lot more interaction between the Asia Pacific economies, a lot more linkage in with China, which of course is itself slowing. But if you look at what's actually happening in the world, if you look at the year-on-year change in economic activity in the different regions, you have to rebase China, you have to look at it on a slightly different scale. But you can see that actually, in terms of the cycle, in terms of what's driving the economies around the world, they are far from decoupled. In fact, they move very much in synchronization, and in fact, probably the world has never been more joined up economically than it is right now. Which means we cannot afford to be complacent, and we certainly should not think that what's going on over there is in any way divorced from what either is happening or what's going to happen in the economies in this part of the world. So from that point in the middle of last year, where, as I'm sure you'll recall, we had the US debt downgrade, which is actually about the fundamental strength of the economy and finances in the US. It's about the Eurozone and the Eurozone crisis, and concerns starting to come through about China. We saw that deterioration. This chart shows what each month a poll of leading economists, which doesn't include me, I hasten to point out, but what a poll of leading economists around the region think GDP was going to be in 2012. And you can see that from the summer onwards, their expectations for growth this year in different parts of the world started to decline. Markedly so in Western Europe, where expectations of maybe 1.75%, which is still well below trend, but was actually positive growth, have shifted to now expectations of negative growth in Western Europe during 2012. Now, what's happening on those lines? You can see Australia in there may not look particularly significant. Look at what it means for those economies that are particularly exposed to the global economy. Hong Kong, Singapore, Taiwan, South Korea are either major exporters or major financial services centres, very linked into what's going on in the rest of the world. And their expectations of growth have fallen away very, very markedly. So the concern is really, from an underlying economic point of view, a lack of confidence in what the outlook is, certainly weaker, but in many ways, simply uncertainty, seeing this proportion of this change every month, because people are not clear about really what the outlook is. It's important to say that it could be a lot worse. I mean, there are many parts of the world that are in a far worse position than in Asia. Many of the 2012 growth rates that we have in here, in a number of cases, they're stronger than they were in 2011. Certainly, we are seeing recovery and are unlikely to see the scale, we hope, of natural disasters that affected the region during last year. And the expectation is that 2013 we'll see a further strengthening and a further recovery. And there's positive growth in pretty much every economy across the region, including some of those that have really struggled, such as Japan. So we don't want to be overly negative about the environment, but it is still very, very uncertain. Europe, at best, is likely to see a mild recession during the early part of this year. Crucially, I think the expectations over the last few weeks have started to shift about the prospects for the euro. The bailout of Greece, which was far from certain that it was going to go through and still isn't finalised, the debt restructuring we've seen there, it does nothing to solve Greece's problems. If you look at the assumptions that lie behind that bailout programme, even officially by the people who put it together, the assumptions are politely described as somewhat heroic. And there are some far less polite words that are used behind closed doors about really what that means. What it does mean, aside from the fact that Greece is going to need another bailout or something within the next couple of years, but what it probably does mean is that the prospects of imminent collapse in the euro and all that would mean for the financial system have significantly declined. And that's a very key point in terms of the sentiment that we see in the markets. The US has shown more positive signs recently, particularly from an employment point of view, but it's still struggling to regain any real momentum. So as a result, occupiers and investors around the world are nervous. They're uncertain. And they're not behaving on the basis of what they expect to happen. They're behaving on the basis of what they're worried might happen. And that is likely, to some degree or another, particularly concerns around Europe, to remain the case for quite a long time.